Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Thanks for joining us again. Let's get across what we saw overnight. Wall Street ending higher, lifted by upbeat quarterly results from CoreWeave and other AI infrastructure firms, while mild inflation data reinforced bets that the US Federal Reserve will hold interest rates steady in September. So the S&P climbed 0.25%, the Nasdaq up around 0.5%, and the Dow finished flat. So the Russell also doing well, they're up more than 0.5%. So CoreWeave surged 19% after the AI cloud company lifted its annual capital spending forecast and topped second quarter earnings estimates. Data center operators also rose, with Iron gaining along with Applied Digital, and Nebius Group jumped 34%, helped by second quarter results that beat expectations. Supermicro Computer surging 19% after the AI server maker forecast fiscal 27 revenue above Wall Street expectations, and the chipmakers gain. Nvidia rising along with Micron Technology, and the Philly Semiconductor Index up around 2.5%, but does remain about 15% below its record closing high on June 22nd. Well, US consumer prices barely increased in July as the cost of gasoline declined for a second straight month, while underlying inflation was benign, further reducing the odds of an interest rate hike from the Fed next month. The consumer price index edging up 0.1% in July, with core CPI up 0.2%. In the 12 months through to July, the CPI advanced 3.4% after rising 3.5% in June. And geopolitically, Iran and the United States remain at loggerheads over efforts to agree to a permanent end to the war in the Gulf, according to a senior Iranian source who said there'd been no progress in talks to revive an interim deal agreed in June and to find a time frame to implement it. Well, the US two-year Treasury yield fell to 4.2%, the 10-year at 4.68, markets pricing in a 40% chance the Fed funds rate will be hiked by 25 basis points at the next meeting in September, a 70% chance of a hike by October. Australian three-year government bond yield futures fell to 4.53%, the 10-year at 5.02. The US dollar index up slightly, the Aussie is trading at 70.6 US cents. Oil prices rose slightly as attacks on ships in the Middle East continued, and talks to end the Iran war have hit an impasse. However, the gains were limited after forecasters cut global oil demand projections for the remainder of 2026. Brent futures settling at around $89 a barrel. Gold rose to a more than 2-month high off the back of that inflation read. And copper futures fell slightly. Iron ore at $97 a tonne, and Bitcoin, it's trading lower, currently at below 63,500 US dollars. Let's now get across what we're seeing at a macro level. Joining us is Felix Vezina, who is from BCA Research. Felix, great to have you back on AusBiz. Let's begin with perhaps more broadly what you're seeing with the US economy at the moment, given the latest data read.
Thank you, Andrew. So what we've been seeing this year has been a US economy that's doing decently, and that's very important. If we take a step back, the US data has been beating estimates in the start of the year, but it recently cooled a bit. Not enough to show a meaningful slowdown, but the data has stopped surprising positively relative to expectations broadly. And that matters because something that we've noticed is that we have these cycles in the data where if you start having positive economic surprises, it tightens financial conditions. After a while, tighter financial conditions end up slowing down the data. It ends up weighing on growth, and then you end up seeing a loosening in financial conditions. So this cycle is something that we see in the data quite often. It also explains why two things: why economic surprises are not a random walk, and why they are mean reverting. What we've seen since the start of the year in the US is that higher data, better data than expected, despite all the pressures from the Middle East, has been leading to tighter financial conditions. So even though we've seen tighter financial conditions, the US economy has been resilient enough to be handling those tighter financial conditions.
Let's go to that latest read on inflation. CPI pretty much coming in line with forecasts. Clearly falling prices at the pump in terms of gasoline helped, although there's still no clear outlook as to where oil prices are likely to go from here. Is there the risk still of further inflationary pressure on the US economy?
In the short term, yes, but over the longer run, we don't see a backdrop that would generate more price pressures. Right now, price pressures in the US are really isolated and idiosyncratic. They tend to come from energy prices, as you've mentioned, but also from the AI boom. But that latter part is still very narrow. Uh, Importantly, we saw last week that the labor market is not contributing to wage inflation, to general inflation through wage growth, and that most importantly, inflation expectations are still broadly anchored. So it was a good sign that we saw the July CPI report in line with expectations and that we saw core inflation ticking down. So there might be a risk in the short term that things might re-escalate a bit, but beyond that, like the US economy, although it's doing decently, it's not overheating to a point where it would contribute to more inflation.
What do you see more globally, Felix, and how the global economy is tracking at the moment?
Right now, it's doing okay. It's been surprising a bit around the world. Like the economic surprises in Europe have been strong. We don't really expect that to last over the longer run, but more importantly is what's going to happen to the Fed, because the Fed is going to have a big impact on what's happening globally. Right now, they're kind of on the edge of that precipice to hike more. They have a very asymmetric reaction function where they're going to need maybe like one or two hot inflation reports to hike, while they will need like several cool ones to stay on hold. So the risk of a hike is still there. It will really affect the rest of the world. And, they have that hawkish skew. But given the tensions we see globally and the effects it has on growth, we don't expect that hike to happen.
Felix, the Middle East and that big question, where to from here? Because there is still no progress. This has now been going on for months, despite what we're hearing, certainly from the Trump White House. What are you seeing, and what are the prospects that the president will pull some levers to make this happen? Obviously, with the critical deadline of November midterms looming.
So the way we've been framing it is that we are stuck in what we call a kinetic equilibrium. So when we reach the 70 level for Brent, things seem to re-escalate. Iran is starting hostilities again. Whenever we get to that 100 level, the US is seeking to de-escalate. So that's a very important dynamic, and we expect it to last until the midterms. And what's important right now is that neither side really wants to bring oil above $100. And the way we've been describing it, or that our geopolitical colleagues have been describing it, is that went from being a dependent variable to an independent one. Oil prices are dictating how the different belligerents are acting in the Middle East. And what's very important right now is that we're not seeing Israel being pulled into the mix.
All right. So, what do you see as the biggest risks to economic growth going forward right now then?
Right now, the biggest risk to growth is that it starts getting a bit too hot and the Fed really has to step on the brakes. That would be an issue. Outside of AI, the US economy is doing okay-ish, but it's not stellar at all. So more pressure on, if we have more tighter financial conditions, we're going to see more pressure on sectors like housing and all of that. That would be a big issue.
You say outside of AI, is your expectation that you're going to continue to see those huge capital flows into the AI trade?
Yes, correct. And what we're seeing right now, when you look at those companies' earnings, is that they're seeing their revenue increasing. They're seeing like return on that invested capital. So that's important. It's going to keep happening. And it's kind of a story where it's a structural story. In this case, like it doesn't depend on financial conditions like other sectors of the economy does.
And so, Felix, in terms of your forecast there at BCA, do you feel as though the Fed is going to have to hike by the end of the year?
The jury is still out. It's still going to be a matter of the next inflation report. But what we have more conviction on is that the macro backdrop doesn't warrant hiking more than is priced into markets right now. This is the big takeaway there for the Fed.
Felix, great to get your analysis. Thanks for joining us in BCA Research.
Thank you.
All right, let's turn our attention to where we're likely to open on the local market then. As you can see, SPI futures off around 0.25%. Clearly, the focus today will be very much on reporting season yet again, with some other larger results coming to us, in particular the likes of ANZ, Telstra, Origin, IAG, and we'll get across some of that, and also interviews with some of the key chief executives off the back of those results. Join us for the Open in just a minute.